18.
Well, it's been the worst start to a new year in the last 6 years. The Sensex and the Nifty have lost ground for 4 weeks in a row now. What's in store for 2023? Can we expect more from the upcoming corporate earnings? In fact, on Friday, TCS was the stock that was down 3% ahead of its earnings on Monday. Can the union budget lift the sentiment on the Love Street? Hello and welcome to this year's first edition of Editors Roundtable. I'm Sonia and with me there's Prashant, Nimesh and Nigel. Folks, it's been, the bulls have been running for scampering for cover this week rather, and I have to say, I mean, the Nifty fell below the 100-day moving average. You had clearly a downtrending market, and then this TCS ahead of its earnings on Monday was totally sort of, shut down on Friday. What happened?
We saved the worst for the last, right? Last day of the week, really, right? I mean, it was a slam dunk, but all told, it was a 1% cut on Friday. I mean, levels were broken through, etc. But 1%. I mean, but it feels big because we're not used to it anymore, right?
Yeah, Prashant, actually the problem is not about that index level 1% or 2%. The damage has been bigger in the mid cap and small cap. Yeah. For traders, they've lost a lot of money. Even individual portfolios, people have lost a lot of money. So the pain has been because of that, and that's the reason why you're not seeing the follow-up buying from the DIs or from the local investors. They've been the big supporter of this Indian market the whole of 2022. That is missing in the first week. That's the clear feedback. That the FIs have been sellers. That was there last year as well, right? What has changed basically is the FIs, the retail have lost money both in trading and in portfolio level, and that's why they're a little scared to invest in this particular first week of dip.
Yeah, and if you split the week up into two, the first half of the week you didn't have too much of volumes, and the fall came in the second half. Yeah. So when the party was house full, that's why you saw some selling. High amount of participation, and we fell on decent volumes as well. Yeah. Bit of a worry, a little jittery looking screen. Hopefully things recover from here.
It's also like that bad hangover after a very big party that you have, right? So this new
full house
Christmas
party, hangover. You guys are still in New Year
or
mode,
maybe we experienced some of that earlier. Let's get to the market action, Prashant.
Absolutely. So the laggards have come back, right, this year, at least in the first week. And the laggards, I mean, markets like China, markets in Europe, those are the ones which are which have come back pretty strongly. I looked at numbers from the lows of October. You can look at the returns from the 1st of November over the last 2 months, 2 months and a few days, and it's pretty stark. China, for example, I mean, you look at the Hang Seng market, it's up 43% from the lows in October. The Euro Stoxx 50, which is made up of the 50 largest, most widely traded stocks in Europe, that is up 22%. Nifty is up 5%. Usually, if you were in some phase in 2022, it would be exactly the reverse. Nifty would be up some, 20, 25%, and other markets would be down. So the outperformance was on the side of the Nifty, which is reversed a little bit, which many actually were alluding to, that perhaps that is that is something which may happen, and I think it's playing out. How much more, of course, is the question. I want to get some levels out of the way, at least on the Nifty. So on Friday, we got that near 1%. I mean, actually, we fell 1% and then pulled back a little bit. We ended about 0.75% lower. The 26th of December low is 17,774. We came within 20 points of that, and we saw a nice, clean 100-point bounce. So that becomes the first kind of marker. If that goes, then you're talking about some slightly larger, bigger handle numbers. The next one is, to my mind, about 17,500, roughly 17,472 to be precise. It is the 38% retracement of the entire rally from the lows of June, which was 15,183 to the all-time high. That is around 17,500, just rounding off that number there. Will we actually do that? I think a lot of it will depend on what is next, right, which is earnings season. You get the IT services companies, which will kick it off on the 9th, which is Monday. TCS will report after market hours, and then one after the other, we really get into the thick of it. I think from a IT services perspective itself, it's very interesting because it's one large grouping which is down quite massively. And if, markets get some amount of confidence that things are not so bad and maybe FY24 eventually things will get okay, it could be an interesting space. Although on Friday, that is today, stocks did sell off. I mean, the index was the top loser going into the earnings season, so the market doesn't believe it will be a good one. US, from a global perspective, it's about labor market data. So the US jobs data today is important. All the high frequency numbers that we've gotten so far, they all indicate that the labor market is far too hot and far too strong for the Fed's comfort. All falls in 2022 last year have been accompanied by a rise in the terminal rate pricing of the market. Basically, market pricing of what the Fed peak rate will be. every time it moved up, market fell. It's been stagnant. That rate has been stagnant since mid-October. And I think, to my mind, that remains the global risk. If the labor market continues to be hot, as the FOMC minutes indicated, the market may be mispricing what the Fed and what its resolve is to keep hiking rates to bring inflation lower. So just a few points. Nimish, on a dealing room side, what are you picking up?
So, Prashant, as we all say, right, the big boys are back and they're back on the sell side. So the FIs have started the year on a selling mode. For the last few days, they've been aggressive sellers in the cash market. And the big fear is, whether the money will move from India to China, because that's been a performing market. And normally we've seen some hedge funds, some long-only funds do try to chase the performing market. So there is a bit of chase now happening towards China. So that's a bit of worry from an FI flow point of view. Historically, India has seen a tough market in January. I was looking at data for the last 10, 12 years. The biggest volatility has come in the January month, for Indian markets. 8% down, 7% down. Those kind of moves we've seen. Just look at the last 2 years. In 2021, the Nifty fell, almost corrected 6% from January 21 till the first day of budget. So after that, you saw a bit of recovery, but in that 1 week, it was a sharp fall of 8%. If you look at last year, Nifty made a peak on 18th of January. After that, that level came only in November. So, normally January has been a tricky month, a bit of choppy month as well. So maybe history is playing again in the first week of January. So that's something to watch out for. I guess from a trigger point of view, as you rightly pointed out, earnings will be a very important thing to track. TCS will report on Monday. But the overall earnings season is something which will have a big impact on individual stocks. And I guess the fresh allocation of money into emerging markets will start next week. So that will be very important from a flow point of view. I guess, the other angle to the FI or the larger investors coming back is there is a sharp indication that big blocks are coming again. So again, that will be a big supply overhang on many individual stocks. So that's something to watch out. But I guess the start is difficult, and January has been historically a tough month. But I guess the flow from EMs will be very important for the India markets starting next week.
Okay, in fact, joining us now on the show is Pankaj Tibrewal of Kotak Mahindra Asset Management Company. So let's get his view in. Pankaj, it's been a rather rocky start to 2023. How are you feeling about it? Do you think this is going to be a year of underperformance that India sees vis-a-vis global markets?
Hello, everyone, and hi, Sonia. If you look at last year, we have seen a very sharp outperformance of India. India was up 4%. Whereas the rest of the world was negative 20 to 25%. Our sense is that this year will be a tricky year for India. And the starting point of valuations are not very comfortable. We are at about 18.5, 19 times 1 year forward. And also some of the macro indicators are softening. We did an extensive survey at the ground level in the last 1.5 months. And except jewelry, airlines, and hotels, most of the other consumption discretionary areas like apparel, footwear, electronic, consumer durable, building home materials, everything is seeing softening, and nobody is able to explain why there's so much of softness in demand.
I do want to take that discussion forward, Pankaj, so just hold that thought. Nigel has put together some very interesting data. So there's this whole capex recovery theme that has been gaining traction with corporate loan growth expected to pick up. Nigel, tell us, what is the role of rating agencies in all of this?
Well, guys, we've been getting a lot of banking operational updates that have come about. And one thing that is clear is there is some traction that we're seeing on ground. The question we're asking is, will rating agencies be a bit of an ancillary to this big loan growth that we're likely to see? First of all, the capex recovery is likely to take place in the coming year. If that's going to happen, then the corporate loan books will show growth. As of now, retail books are showing more traction. If the corporate loan growth is going to pick up, then could rating agencies get more business? So we thought, let's just focus on this particular point. Now, depending on the kind of instrument, now I've reached out to various corporates, various rating agencies, and some banking names as well. Depending on the kind of instrument that the corporate is raising, well, they either require a single rating or a double rating. So that would mean more business. And as we know, there are just 3 big players out there, and that they are from the listed space itself. So CRISIL, ICRA, as well as CARE Ratings. And between them, I understand there's no hard data out there, but I think between them, they have roughly around 75 to around 80% of the market. That's the rough number that I got. What works for rating agencies? Well, if there's going to be more business, then operating leverage will play out, because employee cost is the highest amount of their expenditure. That's point number one. Second factor is they've been giving solid cash flows, the balance sheets are clean, and dividend yield has been very, very high for them as well.
So put all this together, maybe they could be favorably placed in case this capex cycle recovers, corporate loans recovers, and then they get incremental business. Valuation wise, well, we know, some of them, because of the promoter entity, S&P, Moody's, as well as, a clutch of banks out there. Depending on that, there is a valuation gap out there. Though CRISIL is the market leader with more than 30% of the market share. What are the other couple of aspects you need to note for these rating companies? Well, one is if there's widespread growth, there is higher amount of corporates and it's spread among them. That's what leads to higher business. The other factor is some of those large corporates out there, they give fixed based business to them. So they pay just one lump sum. That would mean higher volumes. It may not translate into higher revenue. So just thought we'll put out this piece. Banking loan growth is likely to take off. Will rating agencies participate as well? Back to you guys.
That's very interesting. Identifying a new theme potentially on the back of this entire corporate credit kind of recovery. Nigel, thanks very much for that. Of course, Nimesh, I mean, the big name in that space, CRISIL, as Nigel pointed out, was one of the top holdings of the late Rakesh. Right? I mean, so, absolutely. Pankaj, do come in. I don't know if you have a view on rating agencies, if you'd own any of them, or, I mean, to broaden that question, what is the best way to play this recovery, credit recovery that we were highlighting? Is it banks, NBFCs, or some of the ancillary spaces like these agencies?
So the best way to play, Prashant, is the banking sector, I think, and that has shown traction over the last 3-6 months. And just to give you some numbers, that there are 4 parts to the loan growth. The SME, which is doing well, the retail, which has been firing for last many years, when the corporate slowdown was there. Now, incrementally, what is happening that the working capital demand has gone up. And if you look at, the overall liquidity into the system has been tight. And as a result, working capital needs by the corporates have gone up. And that's also fueling the incremental credit demand into the system. And the last but not the least, if all the PLIs were to get executed, if private sector capex was to kick on, where we are seeing early signs of it, I think you could see incremental another $15 to $18 billion of annualized demand from the private sector on the capex side. So I think penciling in about a 15 to 17% credit or demand growth for the banking sector should be a reasonable one. And the best way to play is through the banks. And I think and obviously in the last 6 months, we have seen a very strong performance on back of that.
Got that, Pankaj. Good inputs out there. Well, just hang on, Pankaj. It's a new year, and with it comes new opportunities. So what should investors own and avoid in 2023? Nimesh, what are the brokerages saying?
Well, Nigel, looks like how 2022 was, even 23 is going to be very stock specific and very sector specific. So let me just run through what the brokerages are saying, and that's actually going to help the viewers how to identify the winners and the losers. So look at for 2023 what brokerages are saying. Let me first focus on the underperformer of last year, which is the IT index. The IT index was down 25% last year. And within that, most of the stocks were down 15, 20% or more than 40%. Now, what are the key things to watch out for? What is JP Morgan saying for IT stocks? The revenue growth reset from mid-teens to mid to high single digit is what they're expecting. They are expecting moderate growth recovery even beyond FY25, FY24, and they continue to be cautious on the sector. In fact, JP Morgan has not a single overweight within the IT name. So they're neutral on 4 stocks, which is Infosys, Persistent, Tech Mahindra, and Emphasis. And they have a long list of underweights, which includes TCS, Mindtree, Wipro, HCL Tech, L&T Tech, and Tata Elxsi. So that's the IT sector. Still cautious view from JP Morgan. The other big underperformer last year was Pharma Index. That index was down 11% in 2022. Now, what is Bernstein saying? Bernstein's view is the margins are going to improve after a flat 2022 in 23, and the sector valuations are now back to 10-year average. So look out for valuations in the pharma names. What are they betting on? Cipla, Sun Pharma, and Gland Pharma. These are the top 3 bets of Bernstein within the pharma names. Now look at the outperformers of last year. There were a couple of outperforming sectors: oil and gas, autos, banks. Bank was the biggest, of course, everybody knows that. So look at the oil and gas now. That index was up 14% in 2022, but Citi believes there are a lot of policy headwinds, tailwinds, which can help the sector. So they are favoring city gas companies and the gas transporters. So on the back of macro backdrops, they also believe OMCs could do well. In fact, they've opened a 90-day positive catalyst on one of the city gas companies, which is IGL. They are bullish on IGL. And apart from that, they've put some pair trades in the oil and gas space. So they're overweight on GAIL and BPCL, while they're underweight on Petronet LNG and IOC. So that's the oil and gas sector. Look at the other big sector which did well in 2022, which is the auto index. That index was up 16%. But Jefferies believes that the sector is poised to deliver strong returns in this year. The demand is recovering, and they see a 12 to 18% volume CAGR for all the three segments, which is PVs, two-wheelers, and trucks over 22 and 25. So they are bullish on. And within that, they're bullish on TVS, Tata Motors, Maruti Suzuki, and Eicher. They are the top picks by the Jefferies. Now, the last sector is the banking sector. It's been a big outperformer in 22. The index was up 21%. Even now for 23, they believe that the momentum can continue for the banks in 23 as well. So CLS has put out a note. Their top pick is Axis Bank, followed by ICICI and SBI. They've upgraded IndusInd Bank to buy now. And after the big outperformance in Bob, they've downgraded Bob to outperform. So within sectors, you'll have to identify the right stocks. But as I said, 23 is going to be mirror of 22, and individual sectors and stocks will be very important to get the alpha.
All right, Nimesh, thanks a lot for that. That was very helpful. But guess what? Next week, all eyes will be on the IT earnings. So we'll come back and talk a little more about that. Don't go anywhere.
Welcome back. You're with us here on Editors Roundtable. We've been discussing what's happened this week, and of course, we're looking ahead as well. Now, one name which I think a lot of people have lots of questions and queries about is Bajaj Finance. This is true for retail audiences. It's true for institutional fund managers, just because the sheer number of people who own it, because of course it's done so well. I'm talking about Bajaj Finance, this is a name which I think portfolios really want that this does well. Why? I'll tell you in just a bit. But the stock returns first. Like this week, it's down 10%. In 2022, it was down 6%, and from the all-time high, it's down about 26%. By the way, I pointed this out earlier. 2022 was the first negative year for Bajaj Finance in 10 years, right? So it's not done very much for almost a year and a half or so. What's the reason for the latest fall? The numbers, the business update which they presented, Q-on-Q loan growth was 5.7%. Market expectation was 7%. Some said, well, what's the big deal? It's still good growth, strong growth on a year-on-year basis, but the markets are markets, and they did not like the numbers. Stock was marked down. This is the reason why I think, this is a name which really has to do well for that feel-good factor to return in portfolios. Mutual funds own about 36,500 crores of Bajaj Finance in portfolios. This is data from Value Research as of the end of 30th of November 2022, the latest data that we have. Look at, this is, what each of these schemes has as a percentage of their total AUM. Axis Long-Term Equity owns 9% of Bajaj Finance as a percentage of its AUM. You can see the other schemes. There is Motilal Oswal Flexi Cap, 6.5%, DSP Flexi, UTI Flexi, SBI Focused Equity. And I've kind of limited the list. It's a very long list. As you can see, 36,500 crores of Bajaj Finance is owned by mutual funds. So it's a large number. Now, to a very cursory kind of look at perhaps why is the market marking down this particular stock. Look at growth rates. I'm just presenting 2022 actual, 23 expected, and 24 expected. You look at Bajaj Finance as compared to HDFC Bank, and you realize the growth differential in loan book and the stock price is very closely correlated to loan growth in the case of Bajaj Finance. It's not what it used to be. I mean, Bajaj Finance has grown as 40%, 70%, 115%. I went back and looked at numbers, but now this is in the 20s, right? High 20s, solid 20s, but still in the 20s, more than HDFC Bank, but the differential is not what it used to be. Look at the valuation comparison with HDFC Bank, and then it becomes even more stark. On a one-year forward consensus basis, Bajaj Finance is 6.5 times, HDFC Bank is 2.9 times or so. If you don't compare it to HDFC and just look at what Bajaj Finance's own history is, as I said, 6.6 current, historical average is 4.4, so it's still pretty pricey as compared to that. The peak, of course, is about 9.5 times from where it has actually dropped off quite a bit. What next? I think the single most important factor is management commentary post the earnings on the earnings conference call. I remember a few years back, you had a situation where the numbers disappointed. The management came on the call and said, well, this was deliberate. This is strategy, and the stock markets liked it. Will we see a repeat of that after the third quarter earnings is something to watch out for? I mean, just a couple of other factors. The absolute high net interest margins that the company enjoys perhaps should limit any damage to their margins because of the interest rate environment. competition is high. And of course, for the NBFC sector, the valuation dispersion is huge. There are NBFCs trading at 1-time book, and there is this Bajaj Finance, which is at 6.6 times book. So the question is, will the laggards do well or the leader start to outperform once again? But I think there is one thing which history has shown us over the last 10 years. It's not paid off to bet against Bajaj Finance. It's always come back stronger than before. Will it happen immediately or will it take time is something we need to wait and watch. But that's enough from me. Sonia, IT services is going to be the focus next week when we come back, starting with TCS, which reports on Monday.
Oh, absolutely. So earnings season is going to come in thick and fast, right? TCS begins on Monday, followed by HCL Tech and Infosys on the 12th, followed by Wipro on the 13th. And then you have big banks like HDFC Bank and ICICI Bank coming through in the rest of the month. Now, for the IT sector, the expectation is that the earnings will be on the weaker side because it's going to be a soft quarter impacted both by Q3 seasonality as well as the worsening macro, setup. Now, if you look at the IT sector, HCL Tech, remember, mid-quarter said that there were higher furloughs in high-tech, BFSI and telecom. And just to put a few numbers before we wrap up the show, HDFC Securities expects revenue growth for the sector to decelerate from 13.5% constant currency in FY23 to 8.5% in FY24. And the growth rates across the board are expected to slow down for TCS in this quarter, just 1.5% growth, Infosys as well 1.5%, while HCL Tech will be about 3.5%. Now, the key things to watch out for, and I want to toss this question to Pankaj as well, how are the tech budgets for calendar year 2023? Has there been a cut down in client spending? If the tech budgets are flat and large deals are absent, can IT see double-digit growth next year, or will they have to scale down their earnings? Pankaj, over to you. What's your sense of what the commentary could look like from the IT companies?
So the sense we are getting is that the commentary on the demand and the revenue growth could be more muted this quarter. What we are hearing is that the IT budgets across the board has been quite muted for CY23, and that will show on the commentaries when we enter into the earnings season next week. But the only positive will be the commentary on margins. I think across the board, companies we expect to come in and talk about positive tailwind on the margin side, because that will clearly be shown in the hiring rates, which we have seen over the last 2 quarters, that has materially slowed down. Attrition has come off. And I think margin levers will be a positive surprise from a commentary perspective moving into the 4th quarter. But demand, we believe, will be more muted. IT budgets are more muted globally.
All right, Pankaj, we'll let you go on that note. Thanks a lot for joining in. And to all you viewers, have a great weekend. Thanks for watching Editors Roundtable.